First up, pressure from consumers and government has seen the spotlight turn on costs in the investment industry. Low returns also enjoyed by investors over the last few years have also had an effect. So how is the industry responding? Sanmarie Greer from Sanlam Collective Investments joins us from Cape Town to discuss the issue. It's obviously a very contentious issue, Sanmarie, when we talk about costs, especially in a low yield environment, which is where we firmly are finding ourselves as we go forward. Your thoughts in terms of where we are, firstly, on the cost debate?
Absolutely right, yes. Cost is always a critical factor that any investor needs to consider when it buys anything. So for example, if we buy a house or a car or a significant capital outlay, we always consider the costs. And sometimes with investments, that isn't always the case. Consumers doesn't always consider the costs. So as you have stated, over the last couple of years, we've seen low yielding markets or sideways markets. That always results in us seeing stark contrasts between costs and performance. And it's very critical that investors should look at that. Also then, the industry needs to respond to these changes in terms of the cost changes and the returns that the market is offering.
Sanmarie, we just wanted to get some reasons for the focus. Obviously, we've mentioned the performance, and when people look at the net effect after costs, with lower returns, it obviously makes them more cognizant of the importance of the costs. But we seem to get a few different things happening at the moment. We've seen the effect that ETFs have had in developed markets like the States in shaping both the costs in passive investment strategies and active investment strategies. Do you think that there's something underway in the South African market at the moment which talks to that?
Absolutely. There's always ongoing debate around costs around active versus passive investments. Typically, your passive investments is a lot more cost effective than an active investment would be. Your active investment always then aims to or endeavors to provide alpha and to outperform the market. So yes, that's certainly something from the international markets that we will see develop in the South African markets, and there's certainly been a lot of debate and discussion around that in the recent past.
Sanmarie, just coming back to the unit trust industry and maybe breaking up the cost formats. So you have an initial cost, then you have an annual cost, and then there's the performance element, as Warren was referring to. Can you just perhaps give us a little clarity on the costing structure as we know it?
Absolutely. So basically, firstly, it's important for investors to know that in the collective investment industry, there's a clear disclosure around the cost that is included in the portfolio. It is what we term your total expense ratio. So investors are able to see how the cost structure is made up in terms of the performance, and that is disclosed in the media, in the printed as well as the electronic media. So that is information that's readily available. And also what we've seen is that investors is becoming a lot more savvy. They're asking a lot more questions, they're a lot more educated, and they actually do inquire a lot more around these costs. So typically, like you've said, you will see your initial charges, which will be disclosed to investors. You would see your ongoing costs through your total expense ratios, and those costs are clearly disclosed in any applications that investors would complete, as well as the advisors would disclose this information. What we're also starting to see in the industry is that there is some regulation internationally, for example, key information documents, which we're currently working on from an industry perspective. Those documents typically would disclose a lot more information in layman's terms so that investors can really understand what they're investing in, what the costs associated with the product are, as well as the risks.
Sanmarie, obviously that transparency, it's a kind of like a chicken and the egg story, because we obviously saw changes that came through phase in terms of letting clients know exactly what the financial advisor, for instance, is getting paid when an investor signs up. And that's created, I guess, more awareness. When we come down and we break down the collective investment schemes, we've had this debate on the show with a range of participants talking about this effect of how performance fees come into this, and especially trying to decipher the performance fee. What exactly is the investment manager getting paid? And is the sharing rate, as they call it, justifiable in terms of the performance they deliver? In terms of your assessment of what's going on at the moment, where do you expect the costs are changing? Where's the biggest difference being seen in terms of the cost structure between the administration fee, obviously the investment manager fee, and then the fees paid to financial advisors and wealth planners?
Yes, so typically we do see that there is that change from a cost structure perspective. Maybe first if we deal with performance fees. So performance fees are also disclosed to investors. It's based on a certain benchmark, and should your active fund manager outperform that benchmark, he may be, according to the fund's mandate, provided it's approved, be entitled to a performance fee. There's also various other fees. Investors will pay a fee depending on whether they go to a management company directly or whether they choose to work through an advisor or work through an independent financial advisor or use an investment platform, typically, which gives them a lot more selection. So those fees are broken down in those various different components.
Sanne-Marie, if we look at the future, how do you think things or the landscape is going to change in the short term, medium term and longer term when it comes to unit trusts and the cost pressures that we're seeing now?
So certainly what we're seeing from a regulation perspective, in the shorter term, there's, as I've mentioned, a number of areas that we're looking at from an industry perspective and where there's further developments. But as we see it play out in the medium to the longer term, what we've certainly seen is the investors becoming more savvy, asking more questions, and there will be a lot more spotlights on costs, how it's made up, and who along the value chain receives various portions of those costs and how those costs are calculated. So certainly from the industry perspective, we certainly expect to be a lot more focus being placed around costs. We've also seen that in the papers released by National Treasury recently, that they're also focusing around costs in the broader financial services industry and particularly focusing on the retirement structures and retirement funds.
Thus far, Sanne-Marie, just how far have you seen any investment managers changing their fee structures, or have you seen the effects of competition? We all know that there's a lot of investment managers out there, but it seems that the bulk of funds are still dominated by the large players. Have you seen any changes in the way investors are charged for these services?
Now, I think largely across all the bigger players or the major competition, the fees vary a little bit here and there, but it's largely similar between the various different players. There's not a major differentiator, what we've seen certainly in the short term, but certainly if there's more pressure on costs and we continue in these low yielding environments, we certainly can expect to see those cost pressures increasing and the playing field changing significantly.
One more question.
Yeah, just one more question. Obviously, there seems to be quite a big difference between the costs in the passive industry and the active industry. I mean, it just says to clients that if they're not sure about choosing an investment manager that can outperform the index, they're better going with the ETF investments. Just how much is the passive strategies affecting all of this at the moment, Sanne-Marie?
It's not currently playing a major effect. There's a lot of discussion and debate, but we haven't seen a major move at the moment from active strategies to passive strategies. But that doesn't say that that may not happen in the future. There's certainly a lot of discussion and debate, a lot of question around it, and investors may start looking at more passive products just to receive that benchmark return, and they would look at your excellent investment performance to provide them that additional alpha that is required.
Sanne-Marie, thank you so much for your time. Sanne-Marie Greef, CEO of Sanlam Collective Investments.